Good morning and welcome to today's webcast, 2019 Year-End Tax Update for Technology, Communications and Media, and Life Sciences Companies. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And with that, I'll turn it over to Rich to get us started.
Welcome, everyone. Thanks for joining our annual year-end tax update for technology, communications, and life sciences companies. Excuse me. We do this webinar every year to help remind companies of the year's evolving tax issues. We spent the last year implementing the provisions of the Tax Cut and Jobs Act during the preparation of thousands of tax returns and tax provisions. During the year, Treasury released additional implementing and explanatory guidance, and there are still some outstanding issues that we are waiting for some guidance. We have learned a lot this year, and we want to share some of that with you. Also, during 2019, there was a lot of state tax law changes in light of the 2018 Wayfair decision. This is quickly changing companies' state tax exposures. Today, we will go over some of the changes that will impact your companies. We can't cover them all within an hour, so we're addressing some of the more common items. My name is Richard Croghan, and I am the tax leader for our Technology, Communications, and Life Sciences Industry Group with Moss Adams, and I will be your moderator. Joining me today will be Kunaal Patel, a tax partner out of our Silicon Valley office, and Kristen Scherer, a senior manager in our state and local tax services groups, and she is based out of our Dallas office. Today, Kunaal will cover a number of items to keep in mind on your 2019 federal tax returns and calculations. Kunaal will provide a general corporate update and some friendly reminders of some of the changes from the Tax Cut and Jobs Act. We're also seeing a lot more activity on the employment tax front, and he will discuss some of the issues there. He'll also provide an overview and reminders on tax credit issues that we are seeing. And lastly, Kunaal will provide an overview of some international reporting issues that impact many of our clients. Kristen will cover the quickly evolving world of state taxes, the Supreme Court decision in Wayfair, and the legislative changes in light of that decision is creating many more tax issues for all types of companies on both sales and use taxes and income franchise taxes. As noted in the introduction, today's webinar qualifies for CPE. To get the CPE, you need to answer 3 of the 4 polling questions. The polling questions aren't that hard. We just need to make sure that you know that you're following along. So our first polling question here is, what is your biggest concern with 2019 taxes? Is it fully understanding and implementing the tax reform changes? Is it the international changes, more specifically, within tax reform? Is it the state tax changes, that the state laws that keep on changing? And there are numerous changes this year. Or was it ASC 740 and accounting for income taxes? So I'll give everyone about 30 seconds to submit their answer. We're not going to go too deep into ASC 740 here. That's a whole hour or more that we've done in the past, and we understand that it is a complicated area, but we'll just highlight a few of the items that really impact that particularly. Then I hope everyone's having a great day and preparing for the Christmas season. All right, I think that should be long enough for everyone to submit their answers. So I'll go ahead and move it along. And it looks like about half of you are still concerned with tax reform changes. We understand that. I mean, there's just still some, the guidance isn't fully clear or fully complete. And there's some unintended consequences, and so companies are changing some of how they account for certain things and how they track different items. So we understand that. We're with you here. But other than that, everything, various concerns on international, state, and accounting for income taxes. So we'll touch on all of them. And with that, I'm going to turn it over to Kunaal, and he can provide the federal update. Kunaal.
Thank you, Rich. Just as Rich mentioned, wow, there have been a lot of changes over the past few years. While many tax reform changes are already placed into effect, we did have a lot of important federal tax guidance issued this year, and states were very active in enacting legislation to broaden their tax base. For those companies adopting the new revenue recognition standards, it is important to be aware of what you are doing on your financial statements with the adoption of ASC 606. There are areas where changes under ASC 606 will change the long-standing tax treatments. Your company may have an agreement with some contingent payments. These contingent payments may not have met the all events test. However, under ASC 606, these payments may be included in income, and under the revised Section 451B, for tax, it is possible the contingent payments may be included in income earlier than was previously required. Incremental costs incurred to obtain a contract are capitalized. Costs are amortized over the period goods or services is transferred to the customer. It may be expensed if the period is less than 12 months. Revenue recognition documentation may have projected expenses included in a company's revenue calculation. The tax deduction for those expenses would be determined under the rules of liabilities, which could result in recognition at a different time. It continues to be important for companies to review their tax accounting methods every year to make sure they are properly managing their tax burden and exposures. As you adopt the new revenue recognition standards, you may need to change your tax accounting methods with respect to deferred revenue. Under the new laws and implementing regulations, there are 6 different ways shown on this slide that you could have a tax accounting method change. Qualified small business stock exclusion. The tax benefit for qualified small business gain exclusion provided by the Internal Revenue Code is very valuable. We are getting an increasing number of questions from companies about whether their stock qualifies. Qualified Small Business Stock, or QSBS, is the stock held in a qualified small business. An investor may exclude between 50 and 100% of the capital gain on the sale of a QSBS, depending on when the stock was first acquired. Many shareholders seem to be taking advantage of the benefit, but many questions still do remain relating to the technical issues, requirement satisfaction, and documentation and communication. The basic requirements of a qualified small business stock is that a company is a domestic C corporation, the stock is issued after August 10, 1993, the stock is acquired by a taxpayer directly from the company for money, property, or services, and the tax basis of the total gross asset of the corporation at all times from August 10, 1993 until immediately after the issuance of the taxpayer stock must be less than $50 million. This is a complicated area in analysis, so please do reach out if you have any questions. The business interest deductions was also impacted by tax reform. The business interest deduction limitation disallows all net business interest expense in excess of 30% of a taxpayer's adjustable income of a business. Any amounts subject to this limitation may be carried forward to the future year indefinitely until it is able to be applied. The 30% income limit only applies to net business interest expense based on the respective business's adjusted taxable income. The net business interest expense is the excess of business expense over business interest income. For tax years beginning after December 31, 2017 and before January 1, 2022, the adjustable taxable income will be computed with the exclusion of depreciation, amortization, depletion, and business interest expense. For C corporations, all interest is considered to be business-related when calculating the interest deduction limitation. There is no grandfathering for existing debt, and due to that, we have seen some cases, particularly with some leveraged buyouts, that are unintentionally putting taxpayers into a cash tax position because of this new legislation. As you start preparing for your 2019 audits, a couple items you might want to keep in mind where we have seen some issues come up over the past year on tax provisions. From a deferred tax asset valuation allowance perspective, companies should closely look at scheduling exercises as the results may be different than what we are accustomed to. Be mindful of scheduling that might be necessary if you have foreign tax credits. You may also need to account for new regulations such as the proposed 382 regulations if they become final. Scheduling will be likely required to monitor the utilization of NOLs and credit carryforwards, with pre- and post-tax reform NOLs having different expiration periods and utilization limitations. This is particularly important if you have large deferred tax liabilities. Companies will also want to consider the need to set up deferred taxes if you have some interest expense being carried forward due to the interest limitations under the new 163J limitations. Under the proposed 382 regulation, the safe harbor for the new BIG is in jeopardy. During September 2019, the Treasury Department and the IRS issued the proposed regulations under which, if finalized, it will severely limit the ability for corporations to avail themselves of net operating losses following an ownership change. Specifically, the regulations would eliminate the safe harbor that the IRS established more than 15 years ago that allows corporations to increase their Section 382 limitation by the gain inherent in their assets. This safe harbor has greatly benefited companies subject to 382 limitations, especially software and biotech companies whose most valuable assets are their intangibles. We expect that these proposed regulations will have a detrimental impact on the ability of many corporations to free up net operating losses following an ownership change. Moreover, the regulations could have a number of negative secondary impacts on issues such as deal valuations and calculation of deferred tax assets. Some additional considerations. There are simplified accounting methods available, particularly for small businesses, such as the use of cash method, and also an exemption from being subject to UNICAP if you have inventory. 100% bonus depreciation is also available for purchase of qualified property made until January 2023. Leasehold improvements are not included. The 2.3% medical device tax is back. This is a tax on the sale of certain medical devices that has been suspended twice by Congress, with the current legislative moratorium scheduled to expire after December 31, 2019. In the absence of further congressional action, the medical device excise tax will apply to certain sales, uses, and lease of taxable medical devices beginning on January 1, 2020. The end of the current moratorium would mean that medical device manufacturers, producers, and importers would be required to report the tax and make semi-monthly deposits to the IRS beginning in 2020.
All right, thanks, Kunaal. So now we're moving on to our second polling question. We also had a few questions pop in, so I'll address these while we have people respond to the polling question. Have you been asked whether your company stock qualifies as a qualified small business stock? So yes, no, or I don't know. As Kunaal mentioned, we are getting that question a lot. But Kunaal, we did get one question on this topic that came in, and the person was wondering whether or not this exclusion applies for stock that's acquired from exercise of stock options.
Sorry, which exclusion?
The qualified small business stock exclusion, whether it applies for stock that's acquired via a stock option exercise.
Typically, I think you have to directly acquire it from the corporation.
So if they acquire it from the corporation, then it would qualify as long as it meets the required holding period.
Correct.
All right. So it's a great benefit for all, and certainly for the founders, it's a real win, and that's where we're seeing a lot of the questions coming in from founders and executives. So with that, we're going to move on past the polling question. So where we see only about 20% of you have been asked about whether the company qualifies as qualified stock option, qualified small business stock. Well, hopefully, if you're asked now, you have some background and you know about the issue, and you're better able to answer, or at least call someone up to help you figure out whether or not it qualifies. And with that, I'm going to turn it back over to Kunaal.
Thanks, Rich. This is sort of a new area for us. We're seeing a lot of questions pop up. We are seeing definitely a lot more employment-related issues for our clients. We have seen questions being posed from the federal and state tax authorities, as well as financial statement auditors, and during the due diligence processes. The Tax Cuts and Jobs Act did make significant changes to the tax deductibility of certain fringe benefits provided to employees that may affect the way employers deliver them. So these slides will outline some of those changes and issues that you should consider addressing. From a meals and entertainment perspective, tax reform repealed the deduction for many entertainment expenses, which were deductible under prior law. The new law is coming into effect in phases, with many expenses that were once 100% deductible becoming 100% non-deductible by 2020. The 50% limitation on the deductibility of business meals has expanded to include meals provided on the premises of an employer, which means meals provided at such facilities will cost more to the employers. These costs, under prior law, were typically 100% fully deductible. They still do remain non-taxable to the employees. In January, the IRS issued a Technical Advice Memorandum, or TAN, providing some guidance on the tax-free meals to employees. The memorandum states that business objectives without a specific policy that is communicated to the employees and meaningfully enforced does not meet the convenience of the employer requirement. So we recommend that companies should continue to review their policies and determine whether a payroll tax withholding accrual is applicable on their financial statements, including estimated penalties and interest consequences. Two other more common fringe benefit issues we see are related to transportation and moving expenses. For transportation, employers are no longer able to deduct commuting benefits provided to employees, such as parking and reimbursement for transit passes. However, this exclusion from income for these benefits received by employee has been retained. Moving expenses, the exclusion and deduction for qualified moving expense reimbursement has been eliminated through 2025, with some exceptions for members of the military. Executive compensation. Under the new 162M rules, the list of covered employees has been expanded to expressively include the CFO. Additionally, if an individual was a covered employee at any point during a particular year, beginning on or after January 1, 2017, the individual will be considered a covered employee for that year and all subsequent years, even after the employee is terminated. As such, all amounts paid to an individual during or after the tax year the individual becomes a covered employee, they could be subject to a 162M, which is the $1 million deduction limit, which includes payouts for incentive awards, severance benefits, and deferred compensation. We're advising companies to consider looking at their independent contractors in their workforce and consider if these workers are properly classified as an employee or an independent contractor. Recently, the California Supreme Court in Dynamex determined that it presumes workers are employees instead of independent contractors. So the burden is now on the entity classifying an individual as an independent contractor. Under the newly adopted ABC test, a worker is an independent contractor to whom a wage order does not apply only if the hiring entity establishes all of these three criteria. This could have implications for companies related to their payroll tax obligations and potentially employee benefits. Tax credits. While tax reform introduced many new changes for businesses, the R&D tax credit continues to provide a reliable opportunity for reducing income tax liabilities from both the federal perspective and states, as there are a handful of states that do make a R&D credit available. We find that many companies aren't fully benefiting from the R&D credit because of some common misconceptions about which activities qualify, what expenditures qualify for the credit, and how the businesses eventually can use the credit. If your company is not paying federal income tax, the company may be eligible up to $1.25 million or $250,000 a year for up to 5 years of federal R&D credit to offset the FICA portion of your payroll taxes. To be eligible, generally a company must meet two requirements, and that is having less than $5 million of gross receipts for that credit year and having no more than 5 years of gross receipts. The payroll tax credit is calculated, and the R&D credit is calculated on the original federal income tax return as usual, and then the payroll offset needs to be made on an original return, and you start benefiting that credit the quarter after the credit is claimed. So how did tax reform impact the R&D credit? Well, we are seeing several cases of increased usability with the elimination of corporate alternative minimum tax. There is still a limitation out there to prevent taxpayers from using the credits to completely eliminate their tax liability. This is effectively known as the 2525 limitation, which restricts taxpayers with over $25,000 in regular tax liability from offsetting more than 75% of their regular tax liability using the credit. Also, due to tax reforms, after 2021, companies will no longer be able to immediately expense costs that are treated as Section 174 expenses, so typically in your financial statements, what you classify as R&D expenses. Instead, companies will be required to charge U.S.-based research expenses to a capital account and deduct them over a 5-year period. Expenses incurred for research performed outside of the United States will be charged to capital account and deducted over a 15-year period. So this could be very impactful for a lot of companies, especially technology and life science companies out there. The orphan drug credit is still available. Pharmaceutical companies may qualify for their orphan drug credit for their drug development programs that have received the orphan drug designation by the FDA. The orphan drug credit post-tax reform provides a credit rate of 25%. The orphan drug credit does allow for 100% of qualified contractor expense spend to be included, whereas the R&D credit caps the includable amount at 65%. The orphan drug credit also can include offshore expenses, whereas the federal standard R&D credit is onshore expenses. Certain criteria do have to be met in order for it to get the offshore expenses qualified. For companies that are eligible for the payroll tax offset, you may want to consider allocating certain costs to the R&D credit bucket because you can't double dip in order to maximize that payroll tax offset if you are a loss company and you have that payroll tax offset available. So international issues continue to be a hot and complex area. We can touch on these topics in a session by itself, but it is important to continue to get ahead of these items, but we wanted to leave you with some quick high-level pointers.
But I think first we're going to start off with a polling question. So this is our third polling question. Make sure that you're answering and submitting. I know sometimes some people forget to hit the submit button. But just to kind of help guide, what Kunaal is going to talk about for the next few minutes, what's the extent of your international footprint? None? Maybe you have some contractors outside the U.S.? Do you have a foreign subsidiary that holds some intellectual property? Do you have just a foreign sales subsidiary? Or do you have full foreign operations, whether they're assembling or manufacturing and selling and researching. So there's all different types of flavors. And what Kunaal is going to talk about really can impact any company, any of these companies, even if you don't think you have international operations. Just, Kunaal, I want to jump in. We had one question come in, and I think I answered it, but I thought other people in the group might be interested. The question was whether or not the medical device excise tax might be deferred again. And the response really, Congress has to act. They have to enact legislation to defer it for an additional period. We all know what's going on in Washington. There's impeachment, but then they've also agreed to a new NAFTA replacement agreement. So there's some legislative work going on. The question is whether or not Congress can have some legislation and funding offset to extend the medical device moratorium. It's questionable. It's always questionable, and I'm not one to hazard a guess. But anyway, so polling question. It seems like most of you don't have an international footprint. Okay, that doesn't mean that you can just kind of sleep through the next few slides. There still are some opportunities, even if you don't have people or contractors offshore. So, Kunaal, back to you.
Thanks, Rich. I'll kind of give you guys a high-level overview here, since most of you don't have extensive amount of international operations. So, if you do have foreign subs, you may have heard of the term GILTI. GILTI imposes a U.S. tax on foreign income in excess of deemed return on tangible assets of foreign corporations. So the goal here is to incentivize companies to return these activities to the United States. The calculation to do it is quite complex. So if you have foreign subs, this is something out there that is likely going to be applicable to you. FDII is a deduction that represents a valuable tax break for U.S. corporations. What FDI does is it creates a U.S. tax deduction based on excess returns from goods and services sold offshore by U.S. C corporations, and it's available to offset your GILTI inclusion. A corporation can claim a 37.5% deduction, which results in a permanent tax benefit of 13.125% effective tax rate, as compared to a 21% corporate tax rate. Two other items I wanted to touch upon that we don't have slides up here on is that be mindful there are proposed regulations out there discussing the sourcing of income related to classifying digital and cloud transactions. And what it is it's stating that revenue should be sourced to the location where content is downloaded or installed onto an end user's device versus being sourced to the location of the service provider. And this was largely to regulation that was set out there to address some foreign tax credit sourcing of income issues. With that, there also may be some important, it might be important from a value-added tax perspective. There are about 40 countries out there in the world right now that have introduced an indirect tax on digital services in one form or another. And given that there are over 150 countries that have implemented a VAT system, it is anticipated that the countries seeking to tax e-services supplied by non-resident suppliers will continue to grow. Therefore, if you have businesses that might be affected by this, you will need to continue to monitor the situation to ensure you stay compliant. With that, I'll hand it over to Kristen for a thought update.
Kunaal, I'm going to jump in here with our fourth and final polling question before Kristen starts her presentation. And remember to choose your answer and then submit it. Have you analyzed your potential sales tax exposure? A lot of companies are doing it, even companies that don't sell tangible products need to look at it. We get involved in a lot of due diligence. A lot of companies are investing in our clients or buying our clients, or our clients are buying other companies. And this is the most frequently raised issue on the tax due diligence side. It applies whether or not you make money or not, and the exposures can be large if people aren't doing it correctly. So hopefully you've had time to answer and submit. I'm going to close the poll here, and about half of you have analyzed it. So that's good. The other half, I'd say, you probably should be taking a look at it. Anyone who has sales, it could impact. So, with that, I'm going to turn it over to Kristen, and she can provide an update of all things sales and income tax from the past year.
Great. Thank you, Rich. I thought we would start today with just kind of a high-level timeline of the sales and income tax, just for a little bit of background. We won't go real deep, and this is definitely not an all-inclusive list. You'll see a sales tax column and an income tax column, but I might jump around and go in order of time. So 1959 was the Portland Cement case, which upheld that an Iowa corporation was subject to a Minnesota tax for just having solicitation in the state and an office lease. In response to that was also in 1959 with Public Law 86-272. This was to limit income tax when you only had solicitation in the state and tangible personal property was being sold. Then on the other side, 1967 was the National Bellas House case. This ruled from a sales tax perspective that physical presence into the state was necessary to establish Nexus. Quite a few years later, we had the Quill decision, which is what we've been leaning on the last 30 years, that some form of substantial physical presence was required. And this case really left it up to Congress to overrule. So it kind of had us in a holding pattern for a long time. Just a year later was the Jeffrey, South Carolina decision on the income tax side that said that the license of an intangible was substantial enough nexus and that physical presence wasn't necessary for income tax. We went on a few years, and then in the 2000s we had the streamlined sales tax and the multi-state tax commissions formed. And both of these were just efforts to simplify and modernize our state and local tax world, come up with uniform definitions, create some thresholds that states began adopting. Then in 2018, as most of you are likely aware, we had the South Dakota Wayfair decision. This was a Supreme Court case that basically held up economic nexus, and physical presence was no longer required for sales tax purposes. The Wayfair legislation sparked a new wave of marketplace facilitator laws that we'll touch on a little bit in a few slides. So let's just do a quick overview to refresh some of the basics. So there are 45 states that have a sales tax or gross receipts tax and a complementary use tax as well. This is usually on the sale of tangible goods and certain services. Generally, the sales tax is paid by the purchaser, but if a seller does have a minimum connection in a jurisdiction, they're usually responsible for collecting and remitting the tax. When that seller doesn't have the connection or nexus, that's when the purchaser has the use tax responsibility. So what is nexus? Traditionally, nexus is the necessary sufficient connection that an entity must have in order for a state to impose the collection of tax on sales into that state. From there, we really have to look at this in a pre-Wayfair and a post-Wayfair world. So pre-Wayfair, we would have looked to a particular state's definitions of doing business. It was still pretty easy to establish nexus for sales and use tax purposes. We saw language in the legislation like permanently or temporary, indirect or direct. So it didn't have to be an employee. It could be a subsidiary, an agent. But then it still had to be physical presence of some kind, but it was expanding. In our post-Wayfair world, physical presence was no longer necessary. If you were exceeding a particular dollar volume or number of transactions, that was sufficient for establishing nexus. As Rich alluded to, this impacts everyone. Buyers are being charged tax where they weren't before, and sellers have an increased obligation to register and file and remit these returns. There's also the additional burden of understanding the taxability in areas where the seller didn't have to before. So in the next couple of slides, it's just going to be a visual representation. So this is a slide that you probably saw something similar in the year-end update last year. So at the end of 2018, we had 31 states that had economic nexus enacted. In the next slide, disregard the fact that this switched from green to blue. That's kind of irrelevant. But this time, we're looking at the end of 2019. We now have 43 states. I led off with saying that 45 impose a sales tax. So we only have 2 holdouts, which is Florida and Missouri. And honestly, they had legislation. It just didn't make it all the way through the session. So we expect to see that in 2020. I'll note that over half of these states followed South Dakota with the thresholds of $100,000 or 200 transactions. But I will point out that some states, such as California, New York, Texas, have a higher dollar threshold of the $500,000. I also want to note that some of the states that were maybe colored on the previous slide and this one did have some updates to their legislation. Either they dropped off the 200 transactions or they changed their dollar threshold. So important to, if you took a look at the end of last year, there could have been a slight change in certain states at the end of this year. So what's your Wayfair action plan? Every company needs to take a look at this, and it's really kind of a 2-part process. So first, you need to determine if you have nexus, whether that's physical presence or economic. I just want to point out, physical presence didn't go away. It's an either or, so physical presence still matters. But you could be crossing the threshold with economic nexus alone. That's generally based on the gross sales from the prior 12 months. So important to know that it's gross sales and not necessarily taxable sales. So this is going to impact many companies that it never did before, that only had a digital or a virtual or remote presence. So once you've determined if you have a nexus, the next step is to analyze taxability. So what are you selling? Do you sell something taxable? If it's tangible personal property, that's usually a little bit less complicated. But what about services? I've listed some examples to kind of walk through. Software as a service is a very widely used term in our world today, but it's really not defined in most states for sales tax purposes. You kind of have to peel back the layers and determine, does it fall into a definition of maybe remotely accessed software, maybe downloaded software, maybe it's really classified as an information service. If it's an information service, is it personal or proprietary in nature where an exemption might apply? Potentially, it's a data processing service. In Texas, software as a service is considered data processing, but Texas offers a 20% exemption for that. So a lot of nuances in this area. I also noted digital goods. We talked about tangible personal property versus an intangible. Digital goods is an area to analyze this. Is it tangible or not? Is it a one-time charge or a recurring charge, such as a subscription? Is the good accessed temporarily or permanently? So there's a lot of nuances to these definitions. I didn't even list on this slide bundled transactions, but that's something to be mindful too. And what is the true object of the good or service that's being provided, and how can you appropriately tax that? So in summary, companies are just having to take a deeper dive into what they're selling and what the taxability of those products and or services are. So if you've worked through that analysis, you've determined where you have Nexus, you've determined you sell something taxable, what's next? What are your options to react to Wayfair? Some companies are making the decision to register and collect and file on a prospective basis. We get the question a lot about those few months of maybe a gap period where a legislation was enacted, but they didn't quite get up and running and filing. We don't anticipate states to be super aggressive, but we really won't know until audit activity picks up, probably in a couple years. So for each entity in each state, you really just need to kind of look at that exposure and see if it's something you're comfortable with filing on a prospective basis. But also know that past liabilities still exist. We talked about physical presence didn't go away. So if you've had historical physical presence and exposure, and then you also triggered economic nexus, you should potentially consider that look-back period, and maybe a voluntary disclosure agreement is a good option. That's going to limit the look-back and also just remediate other liabilities for other taxes, potentially waive penalties. Something else I want to note is the exemption certificates. We were seeing a lot of ramp up of compliance in this area even before Wayfair, so we don't anticipate that the states are going to back off on requiring this. So it's important to just be collecting and maintaining these going forward. Tax amnesty programs are a good way to alleviate some of this, but currently there aren't any live. I think one just wrapped up, so we'll be watching, and if we have any of those, we'll be pushing those out to you guys. But currently we don't have any states with open amnesty programs. So Rich mentioned ASC 450. A lot of companies didn't have this issue because they weren't hitting those nexus thresholds, but now that they do, there's a lot more exposure that's needing to be reviewed and examined and documented and reserved for. And yes, we're seeing this a lot in the buy and sell side of due diligence. So if a transaction is on your radar, be prepared for that. So just to shift gears a little bit, I mentioned that Wayfair sparked a new type of legislation. So many states have begun to impose tax collection and reporting obligations on marketplace facilitators. So usually this is a requirement around companies that facilitate a sale either with advertising or fulfillment or payment processing. So basically a marketplace facilitator is the platform that would connect a buyer and a seller. So the reasoning is that the states felt they can collect the tax due from that marketplace facilitator easier over maybe a smaller buyer and seller. But this is somewhat problematic for smaller platforms or even larger ones that just don't have the technology in place to turn this on. This legislation rolled out very quickly. We're kind of seeing three major categories within the individual state legislation. One is the marketplace facilitator is ultimately responsible across the board, no exceptions. Second is a waiver process where the third party has the option to opt out and choose to remit the tax themselves. And then some have a collect and remit or a reporting responsibility, similar to the Colorado and Washington reporting requirements that we had for sales tax in the last few years. So it's important to know state by state what the legislation currently is and which one of these categories it falls into to understand responsibilities. There's a lot of complexities around this that just haven't been figured out yet. What is the appropriate tax rate? The sourcing of the customers. The platform doesn't always have that accurate information. What's the tax base? Sometimes the platform doesn't know each individual item being sold. They have a lump amount, so not knowing the tax base. Any fees that might be applicable, either that the seller is a fee on the seller or a commission that's being collected by the marketplace facilitator, how are those taxed? And transparency, the seller really wants to have an idea what the marketplace facilitator is doing. What are they collecting? What are they remitting? And sometimes the reporting back to the seller isn't fantastic to have a full understanding. And that's created some fear around the liability. Are there any states that are going to enforce jointly and several be liable? So currently there's 37 states, give or take, in case I missed one, that have these statutes enacted. And like I said, these rolled out very quickly. And usually there's a particular threshold around that, so that's important to note too. But some of the large states have jumped on this. I also want to point out that the definitions are not as uniform as you might think. So New York says very narrow and only includes tangible personal property. Texas has listened to commentary and removed certain businesses, such as the restaurant delivery business. A lot of this impacted industries that probably wasn't intended to, the restaurant delivery business being one of them. So certain states are listening to that commentary and will potentially be adjusting the legislation. California has some limitations around certain local businesses, but overall, the definitions are very broad. Also, I noted Washington, so sometimes this isn't just impacting one tax. So at Washington, you have the retail sales tax and the business and occupation tax. So definitely staying tuned. This is something we're going to be watching a lot in 2020. We expect additional states to kind of refine their rules and regulations. And we also expect some to try to capitalize on what's out there right now in an effort to secure additional tax dollars. So that's kind of the sales tax. A few minutes we're going to shift to income tax. So, Kunaal talked a lot about the federal tax reform, and that did have some specific issues that impacted income tax as well. A lot of states either conformed or decoupled from various areas of this. I'm not going to go into all the specifics. It's just really important to know for each issue, what is the specific treatment in a certain state. And so as you go into compliance season, that's going to be important to know. We also saw many other shifts, and we're going to go through these on the next few slides. Shifts around factor presence nexus, mandatory combined reporting, market-based sourcing. So the next few slides, really just a visual, so you can see the shift on, this is the market-based sourcing. So, this can lead to double taxation with the various throwback and throwout rules, but you can just see the transition to red. Same with this next slide. This shift just really shows today's world that we live in, a very service-driven world. So we're capturing more of the sales factor. So you can see how red that slide is becoming. And then last, the mandatory combined filing. Combining is going to broaden Nexus into more states. So that's just something to be mindful of. That's going to capture more income. So going back to Wayfair just for a moment, Wayfair was a sales tax case, but it can have income tax ramifications. Many states have enacted economic nexus standards for income tax purposes, and Wayfair is only going to give this momentum. So I will address Public Law 86272 again in a minute that we led off with. But for service and intangible revenue, Wayfair is going to give momentum to the states that are asserting these economic nexus laws. And we also talked about how, this combined reporting is just going to broaden Nexus even further. So coupled together, it's just going to definitely create more exposure and things to analyze. So circling back to Public Law 86272, the key elements here are listed, but, really solicitation of the sale of tangible personal property, and this is an income tax law, so that's important to note. So does it still apply? Yes, it does, but as I mentioned, it only applies to tangible personal property. So what's kind of the response to that? So I think that taxpayers are going to be trying to lean on Public Law 86272 more for that protection. And what we're seeing is a little bit more scrutiny around, what is the definition of solicitation? It's not clearly defined. There is some case law. I've even heard, well, registering for sales and use tax, that's enough to be beyond solicitation. You're really availing yourself to that market. Tangible versus intangible. We talked about this on the sales and use tax and the income tax side. Like, how are your products and services being defined? And I mentioned this relates to income tax. We're seeing a lot of net income taxes, additional gross receipts tax, commercial activities taxes, so things that it will not be protecting. And I don't want to not mention, other taxes that could be out there for state and local taxes. We mentioned, the other gross receipts taxes, the commercial activity taxes we're seeing, specific industry taxes such as telecommunication, also specific local taxes. So sometimes those kind of get forgotten or the legislation isn't as evident. So just be mindful of that as you're going into a particular locality. And also, just before I wrap up, I just want to really emphasize the exemption certificates. It's going to be really important for industries that never had to before to be collecting and maintaining those, whether that's manually or through a software solution. But I just want to reiterate further that that's going to be really important as people are having Nexus all over the country and just some compliance that probably didn't have before. So just to kind of wrap up, that kind of covered what we saw in 2019 and listing some of the things we expect to see in 2020. For sales tax, the states are going to be very backlogged. There's a lot of additional registrations and filings that are going to be occurring. Also, if a company is planning to use a service provider to aid them with this, those companies are getting quite a backlog too, so definitely pick up the phone early rather than wait. We expect to see additional audit activity in the next probably 2 to 4 years. That's when we're really going to know which states are being more lenient, which states are being aggressive. But having all your ducks in a row in anticipation of an audit in the next few years will be important. We also expect an increase in that legislation on marketplace facilitators. I would expect, we didn't put a map up for that, but I would expect it to have a lot more coverage when we wrap up next year. I also expect some more clarity around some of the legislation since it was pushed out so quickly. But companies definitely need to be prepared to comply very quickly if you would meet that definition of a marketplace facilitator. For income tax, we expect additional factor presence nexus provisions, again, broadening the nexus definitions, potentially a revamp of Public Law 86272, but we'll see. That might be our 2021 conversation. And just an increase in non-income taxes. Maybe that's the easiest way around, right? Just create a brand new tax. So overall, everyone should just have a plan in place for sales and use tax changes. This legislation is in almost every single state with the exception of Florida and Missouri. And we also need to be evaluating your state income tax and changes that we're going to see in the upcoming compliance season that might have varied from prior years. So I think that that's all we had today for the state and local tax portion. So Rich, I'll turn it back over.
All right, I appreciate that. And I think we have about 5 minutes, probably a few minutes less just to wrap up. But we do have some questions, so I want to kind of bounce them off you, Kristen. One question that came: what's a marketplace facilitator? Can you give some examples? I'm thinking Amazon, but beyond that, what?
Right. So think of like a real basic, like an Etsy. So you're connecting a small buyer with a small seller, and Etsy being the platform that connects them. So it's an online presence that's going to operate as the platform to connect a buyer and a seller.
Okay.
Yeah, and Amazon is another. That's your big example, right? Also, like an online travel company is a good example as well.
So like Airbnb?
Right, or an Expedia, anyone like that. Yep.
Okay. Another question that came in, you mentioned exemption certificates. Are there certain sales that are that are exempt from sales tax? Kristen, you there?
Sorry, I had a quick mute on there. An example maybe in the medical field, tangible items that might qualify for an exemption that's stated in a particular state, or maybe wholesale, so a reseller type exemption, you're still going to want to document those, or just an exempt organization or an entity, a school, a church, colleges, things of that nature. So there are a variety of types of exemption certificates that you would want to maintain.
Okay. And then there was one question I think we've answered, but I thought it might be good for the group just to kind of reiterate it and highlight it. If you hit the economic thresholds for sales dollars post Wayfair and you register, are you exposing yourself to a sales tax audit for pre-Wayfair years?
Right. So it is a possibility. A couple of things, let me grab my crystal ball, right? But if, number one, a smaller taxpayer, we don't expect a state to go aggressively after a smaller taxpayer, right? They're going to be just happy that they're now being compliant. We also don't expect the states to be very aggressive for, a maybe 3 to 6 month period. But, in a year, we're going to probably have a different conversation. I wouldn't let it sit that long. But, we had a lot of states enact on October 1st, 2019, and probably a lot of companies aren't going to be compliant until January 1st, 2020. Our expectation is they're going to be somewhat lenient on that period, or that the materiality is pretty small for that period. So you've got to look at the enactment date for that state, anything from that point forward, if you had no other nexus, like physical presence.
Okay, and just to be clear, the legislation that's been enacted, that's prospective only. It doesn't have retroactive application, correct?
Correct.
Okay. All right, well, with that, I think we got through a bunch of the questions. We didn't get through them all. Apologize, but we'll try to send updates to those that we didn't get to. It is 10:58, and I know that we have some quick wrap-up to do to make sure everyone gets their CPE credit. But I want to thank you all for joining. If we didn't get to your questions, or if you have questions later on, don't hesitate to reach out to any of us or to your own Moss Adams advisor. And with that, Emily, I'll turn it back to you.
All right, thank you. And thank you, Rich, Kunaal, and Kristen, for a great presentation today. As Rich mentioned, if we didn't have time to get to your question, we will do our best to follow up with you afterwards. And you may also reach out directly to any of our speakers. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.